A massive shift is happening in crypto right under our noses. Major institutions and even governments are quietly buying up Bitcoin, creating a supply shock that could trigger what the modern investor calls a generational run. At the same time, the political mood in the US is changing fast, with some saying new laws could make America the world's crypto capital. But there's a catch. While Chris Klein from Bitcoin IRA explains that the OCC has given US banks the green light to hold crypto, other regulators are still standing in the way. Analysts like Ben Cowen see technical patterns pointing to a new all-time high for Ethereum, but others are debating if this bull run is about to end or if it's just getting started. Is this your last chance to get in before the big money takes over completely? In the latest video from the Altcoin Daily channel, the hosts announced that a new crypto bull market is starting now, largely because of major political shifts in the United States. They show a clip of President Trump signing the Genius Act, a bill designed to create a clear framework for dollar-backed stablecoins. This is presented as a monumental upgrade for America's outdated financial system using modern crypto technology. The video argues this move, along with the Clarity Act and an anti-CBDC act, will establish the U.S. as the world's crypto capital, encouraging companies that left to return. This U.S. leadership is expected to cause a ripple effect, with other nations following suit and embracing crypto. The excitement in the video is palpable, and it's true that the political attitude toward crypto in the U.S. is warming up. However, the video presents the Genius Act being signed as a current event, which seems to be a hypothetical or future projection used to build a narrative. The major piece of legislation the industry is actually watching is the FIT21 Act, which passed the House but still has to get through the Senate, where its future is less certain. The institutional interest is very real, though. Charles Schwab's executives have confirmed their intent to enter the space, which is a massive signal. But their timeline remains sometime soon, which is standard corporate speak. So, while the video captures the optimistic feeling in the market, it's worth remembering that legislative changes and corporate rollouts often move much slower than social media does. In the latest video from the Crypto Rover channel, the host explains why he just opened $10 million in long positions on Bitcoin and other cryptocurrencies. He believes the market is entering the very last stage of this bull run, a period he says always produces the biggest gains. His strategy is based on the idea of a major rotation of money, first from Bitcoin into Ethereum, and then from Ethereum into large-cap altcoins like Tron, Cardano, and Dogecoin. The theory of a capital rotation from Bitcoin to altcoins is a well-known narrative in crypto cycles, and it often plays out after Bitcoin hits a new high and then stabilizes. We are seeing some of those conditions now, with Bitcoin's dominance showing signs of topping out and some altcoins beginning to outperform. The consistent inflows into the spot Bitcoin and Ethereum ETFs are a strong supportive factor that wasn't present in previous cycles, adding a layer of sustained buying pressure. However, the idea that this final phase will be over in just 1 or 2 months is extremely speculative. Market timing is notoriously difficult, and while the charts might suggest another leg up is coming, macroeconomic factors and unexpected regulatory news could easily change the direction of the market without warning. The targets mentioned are optimistic and depend on a perfect continuation of current trends. In the latest video from the Lark Davis channel, he asks if we're heading into the final stage of the crypto bull market. He presents evidence that suggests the big run could peak between October and December of this year. Charts from sources like CryptoCon and Titan Crypto point to this timeline, with a potential Bitcoin price top around $184,000, though he thinks it could even stretch to $250,000. This idea is backed by historical data showing that after a period of low volatility, like we've just had, Bitcoin tends to go on a massive rally. Lark does a good job laying out the two main theories battling for control of the crypto narrative right now. His point about an extended cycle driven by ETFs feels especially timely. Recently, we've seen significant outflows from those same Bitcoin ETFs after a long streak of buying, and the price has been struggling to find clear direction. This aligns with his alternative scenario of hitting a local peak followed by a period of consolidation. The market doesn't feel like it's in the full-blown delusional FOMO stage he described. It feels more cautious and heavily influenced by wider economic news, like inflation reports and Federal Reserve decisions. The idea that the old 4-year cycle might break seems more plausible than ever, as big institutional money often plays a longer, more drawn-out game than retail traders. In the latest video from the Ben Cowen channel, he revisits his butterfly effect theory for Ethereum, which he first talked about a few months ago. So far, his prediction has been surprisingly accurate. He points out that Ethereum took the drop he expected, a move he calls going home, and is now in the rally phase of the pattern. It's interesting to watch Ben Cowen's technical analysis play out, especially since his bearish call for ETH to go home was so accurate. His forecast for a new all-time high feels much more possible now than it did a few months ago. The main thing that adds a layer to his analysis is the real-world news surrounding the spot Ethereum ETFs. The approval and upcoming launch of these products could be the massive catalyst that fuels the rally he's describing. The timing of the ETF launch could either accelerate his timeline, or if it becomes a sell-the-news event, it could actually cause the Q3 pullback he warned about. It seems the market's fundamental drivers are aligning with his technical patterns, making the next few months critical for seeing if the butterfly effect continues to unfold as planned. In the latest video from Coin Bureau, Nick breaks down a recent European Central Bank post that has many people worried about the EU seizing their savings. He explains that while it's not a direct seizure, the EU is rolling out a Savings and Investment Union, SIU, to channel Europeans' money into its own priorities. This plan is basically a rebrand of the old, unpopular Capital Markets Union. The video presents a compelling and alarming case, and it's not just pulled from thin air. The EU's push for a capital markets union and a retail investment strategy is very real. My take is that the plan's success hinges on whether they can truly convince everyday people to move their cash from a safe bank account into what the EU deems productive investments. The auto-enrollment pension scheme is the most realistic part of this. It's a powerful tool for directing capital flows without anyone having to actively consent. The most troubling part is the clear desire to funnel money into politically favored sectors. When governments, not markets, pick winners, it often leads to massive inefficiencies and capital being wasted on projects that can't stand on their own. This isn't a conspiracy about seizing bank accounts tomorrow, but a slow, bureaucratic effort to control where Europe's wealth goes. In the latest video from the Crypto Banter channel, the host compares Aptos and Sway, two blockchains that grew out of Facebook's abandoned stablecoin project. Both were built using the Move programming language, designed for massive scale and security to prevent issues like double spending. While they share a common origin, they've taken completely different paths. The video does a great job of framing the Aptos versus Sway debate as a strategic divergence. It feels like we're watching a classic race unfold. Sway is clearly winning the public relations battle right now by focusing on the things everyday users get excited about, like gaming. Recent news about their partnership with gaming giant Netmarble and the buzz around their Sway Play handheld console only reinforces this. They are building a brand that feels accessible and exciting. In the latest video from Crypto Wendy, she talks about a huge piece of news that many people might have missed. U.S. banks have officially gotten the green light to hold crypto assets for their customers. According to the OCC.gov website, the OCC, Fed, and FDIC have reaffirmed that banks can offer custody services for crypto. To get a better sense of what this means, Wendy brings in Chris Klein, the co-founder of Bitcoin IRA. Chris explains that the OCC is the agency that oversees national banks, and their approval is a big step. It signals that crypto is becoming more accepted and could offer a new level of security for investors who might soon be able to store their Bitcoin with a federally regulated bank. He points out that crypto custody is different from traditional custody for things like stocks because with crypto, you're in control of your own digital assets. He says this move lines up perfectly with his company's goal of making crypto a more trusted and secure option for retirement. The bottom line is that this announcement could lead to clearer rules and bring more big money players into crypto, making it safer and more accessible for everyone. The video presents a very optimistic take on banks being allowed to custody crypto. While it's true that the OCC gave this approval, the situation is a bit more complex. A major roadblock is the SEC Staff Accounting Bulletin 121, SAB 121. This rule forces banks to hold their customers' crypto assets on their own balance sheets, treating them as liabilities. This is a huge capital and risk burden for banks, making it impractical for most of them to offer crypto custody at scale. So, even with the OCC's blessing, until the issues around SAB 121 are sorted out, widespread crypto services from major U.S. banks might remain more of a possibility than a reality. It shows a bit of a tug-of-war between different U.S. regulators. In the latest video from The Modern Investor, the host talks about a coming generational run for Bitcoin, one that's different from anything we've seen before. The core idea is that Bitcoin is acting like a black hole, sucking up capital that would have otherwise gone into stocks, gold, or real estate. This time, the buyers aren't just regular people. It's massive institutions, corporations, and even governments buying billions of dollars worth of Bitcoin, and they are not sensitive to the price. My take on this is that the argument about a supply shock is very compelling. The videos focus on the new type of buyer. The price-insensitive institution is what makes this cycle feel fundamentally different. Looking at recent news, the trend of major acquisitions continues. For instance, we've seen reports about corporate treasuries and even sovereign wealth funds quietly adding Bitcoin to their reserves. It's not the loud, retail-driven hype of the past. Instead, it feels like a methodical, quiet absorption of a scarce asset by the world's biggest financial players. The narrative seems to be solidifying around Bitcoin as a permanent fixture in the global financial system, a true digital reserve asset. It will be interesting to see if this slow, powerful accumulation results in the explosive price action the video talks about.